Hey traders, it's Leaf West again with my second video of all time. I thought I'd go over the SPY short I did today, not because it worked out fantastically, but just a couple of things I wanted to show you at how I look at shorting, obvious patterns, and what to watch for and what to avoid. But before I do that, I wanted to show you one of the things I have in my computer software. It's some software I had written to automatically draw opening ranges for me based on the first whatever period of time you look at for an opening range. I trade on a 3 and sort of 5 minute chart, so that's what I look at. Anyways, these white horizontal lines running across my charts come up automatically with every stock or ETF I look at, and it shows me the opening range. And the premise of the opening range, from what I read in research and from what I've experienced, I've had it for about 2 months now, is that when price is below the opening range, it will often try to get back into the opening range, so you have to be careful of that. But if it's below the opening range, you have to be wary that the market is telling you, price is telling you that it is weak and that you shouldn't be going long. You should be looking for shorting opportunities. And opposite to that, if it's above the opening range, you should not be looking to short. You should be looking at adding or buying on pullbacks, what have you. So the longer you have it, the more interesting it is as a trading tool or an aid as well. And I found it a big help, and it's amazingly true. So anyways, my software writes, or it draws these opening ranges automatically, and it draws fib lines off of that above and beyond. If I really shrink this down, you can sort of see where all these lines come in, and it's amazing how often they come into play. For instance, today, where did this spider end up? It ended up right at the first support fib, 2.33, and it's amazing how these algorithmic trading programs that hedge funds have, how they have these things written into their trading software, and this is what it does. This is where price comes into support and resistance. And you can pick any stock. For example, let's pick let's pick Goldman Sachs today and see what happened. Okay, so it draws me the opening range, and you can see that Goldman Sachs fell below the opening range relatively quickly, popped back up, couldn't get back in the opening range, made a lower low, which tells me that it probably isn't going to get back into the opening range the next time it pops up. So I would be looking to short this if I was watching this, if I was hawking this stock. It comes right up, touches the opening range, fails, makes a higher low. So I would think that maybe it's got a chance next time it goes up to make it. So it comes up, pulls back a little bit right into these moving averages and the volume weighted average price. And if I was hawking this is the kind of setup I look for when I'm looking at opening ranges. You show some strength, you come back and retest, and you pull back, and your stochastics gets oversold. You've made a higher low again, showing strength right into moving averages, and I would buy this with the premise that we're going to at least get back into the opening range. And once you get in the opening range, if it fails, it fails. But if it can hold the opening range level, it will very often go to the opposite side of that opening range. In this case, it would have been to the high, but it couldn't. You can see that it didn't hold it. So it comes back down, makes another attempt to get into the opening range, and can't. Puts in these dojis, and then that's all she wrote. And what does it do? It ends up at the 2.330 fib relationship. So it's man against machine, and I know just this kind of thing really helps. I think making money, and I would suggest people pay attention to it. But let's get back to the spiders for to talk about the short I had. I did a blog post on it, and go to my blog site and look at what I wrote this morning, or late morning, or my late morning. I'm 2 hours behind right now, Eastern time, so it was my late morning, I think, in early afternoon. Anyways, obvious to everyone in the world, there was a triangle being formed on the spider, which is a contraction pattern. And after price contracts, it expands. So we would look for the break of this pattern. And my whole premise was that it was going to break it was going to break lower. Price was going to decline. So that's what I really was looking for. And I got involved well, the key level again, the key levels I had for both the upper and the lower breaking of the triangle, because sometimes it's a fake out and it fakes you out one side and goes to the other side, so you have to watch both sides. My lower side was 123.70, and I'll draw a trend line right there. It was based basically on this swing low here, and I'll let you draw that because I want to make a couple points on that. But this bar down here, this green and gray bar that travels along the bottom of my price chart, it's my squeeze indicator. I've got that again. That's another thing I wrote into my code of my software. What it does, it looks at the Bollinger Bands and the Keltner channels, and there's a condition in place that when basically when those are squeezing to a certain point, this bar becomes green, which basically tells me that again price is contracting, and when price contracts, shortly thereafter you should expect an expansion, and that's really where you want to get involved. You want to get involved right when price is contracting and is ready to expand, because that's when you have less time to wait for the price to move. You find out quickly if you've got the right side of the trade or the wrong side of the trade, and hopefully if it starts to expand, you get a good winner out of it, and it runs for a while in your direction. So this was starting, the green was starting to flash. I went short at 124.10 was my first piece. And again, I recommend most people don't play the break of the triangle, because really this pattern is still in place. You're still inside the bigger arms of this triangle. And so really the places to play are the 123.70, and up here it was, you could say 124.65 or 124.75 would be the ones on the upper side that I would look at. But anyways, what I will do on occasion is, if I think the technicals and the internals are lined up, I will buy, or short in this case, short some half a position, half a starter position, on the premise that if it's a really juicy setup, it may not come back and retest the break of the triangle. So I don't want to be not in the trade. So I will do half of a short, where either on that line break, or if I'm ready for it just before that, if I think that's the right trade, and then I'll add to it on the pullback, and I'll add to it more so down here when it shows me that it wants to work. And to make a long story short, I think I added 5 times today, 500 shares at a pop. So I had 2,500 shares short of on the spiders, and the last one was sort of a measured area up around 124.04, I think it was my last ad, and that was based on just some wave calculations I was doing. And I got out of the trade, small winner. I think it was, I don't even know what it was off the top of my head, 20 some cents I think it was total net. I'm not even sure. Anyways, I got out just before the last half hour of the day, because I just don't like holding a position with these algos whipping things around in the last half hour. So and that was really where all the money was made. I got out, I think the last piece was at 63 cents, and it ran right down to, of course it ran right down to my one of my targets, which was the 2.33 fib line at 122.90 roughly, 122.89, and that's where she ended the day. So that's really what I wanted to show regards to the short for the day. Again, the whole day basically was spent underneath the opening range, so even these little moves up, you shouldn't get scared by them. I had my last short at made during this pullback, and some people may have been trying to get long there, but it clearly, you're under the moving averages, you're below the weighted average moving price for the day, and you're below the opening range, and clearly it was not the right trade to try and get long there. Where you want to get long, I think, is if it made it back into the opening range, went up, came back and tested and held the bottom of the opening range, then I would have jumped on that and played it for the opposite side, and that would have been, that's 60-cent move, so that's well worth it. But that didn't happen, obviously, and lo and behold, we had a bit of a collapse. Interestingly enough, the Amazon blog I talked about it got kicked after hours too. So check it out. Anyways, take care. Talk to you tomorrow.